İnniki çıkışımız bilen devam edelim. Azıcık 10 minut ýaly ýerrägem bolsa. İnniki çıkış etjek alymymyz Guncha Babajanova, doktor Guncha Babajanova. Doktor Babajanova 2011-nji ýylda Minnesota State Üniversitesinden ekonomika bölümünden diplomuny alan, bakalavr derejesini alan. 2014-nji ýylda şol üniversiteden Applied Statistics bölümünden magistrasyny alan. Bu derecesi yetmedik ýaly 2019-njy ýylda Clemson Üniversitesinden ekonom kurundan ikinci magistrasyny alan. 2022-nji ýylda bolsa şol üniversitesinden ekonomika bölümünden ilmlarynyň doktory bolan. Şondan bäri bolsa Amazon kompaniýasynda ekonomist bolup işleýär. Bugünkü temasy Specialization and Bank Exit, the Case of Minority Depository Institutions. Dr. Babajanova, rahmet edin.
Hi, everyone. Thank you so much for such a very honorable introduction. Although, I would like to mention, I'm not the very useful doctor like medical doctors are. I won't be able to fix or prescribe you medicine. I also won't be able to give you an investment advice or tax advice, unfortunately. So with that, let's switch gears a little bit and speak about economics. And specifically today, I'll be focusing on a topic that's related to the community development and the role of banks within the community development area. Specifically, I'll be talking about a paper that I wrote as a PhD student, which investigates the effect of the market segment specialization on the bank exit, and specifically exit through failure or acquisition. The focus is on the federally insured commercial bank MDIs, or minority development institutions, which I will explain. There might be a lot of jargon that may be unfamiliar. That's fine. So minority depository institutions, okay, we'll have to use this. Okay, so minority depository institutions are identified based on two criteria set forth by the Financial Institutions Reform, Recovery and Enforcement Act of 1989. Okay, it's working now. Great. So the first criterion based on which a bank is identified as an MDI is if the bank's voting stock, at least 51% or more of the voting stock is owned by minority individuals. Or a commercial bank can also be identified as an MDI by the regulators if 51% or more of the board of directors is minority and the bank is serving primarily a community with minority individuals. So the Financial Institution Reform, Recovery and Enforcement Act identifies a minority. There's 4 different people that are identified as minority: Black, Native Americans, Asian Americans, and Hispanic Americans. And so to give you some idea of what MDIs are, so historically, these commercial banks, or also that's the focus, but they're also credit unions. These institutions were established to provide access to financial services such as, checking accounts, saving accounts that many of you probably have, as well as credit access, loans, student loans, mainly business loans or mortgages, to minority individuals that may not have had access to such services otherwise. So to give you a very specific example, the very first minority depository institution, which was known as the Capital Savings Bank of Washington, D.C., was established in 1888 in Washington, D.C., and the purpose of the bank was to provide financial services to former slaves. So that was back then. Has things changed today? And a little bit. So MDIs still target and serve low and moderate income communities. And what is a low and moderate income community? So low and moderate income community actually has a very specific definition, which was again put together by a Community Reinvestment Act. It's a policy which is enforced on banks. So a low and moderate income community is defined as a census tract in which the median household income is less than 80% of the household income of the metropolitan statistical area in which it resides. And so, therefore, just to kind of give you a little explanation of what I mean by community. So therefore, when I refer to a community, a neighborhood, or geography or location, I am actually referring to a census tract to make sure that I kind of stay consistent with the definition in the Community Reinvestment Act. So that's based on the policies that were set forth. But do the MDIs actually do what they meant to do? And indeed, there were many research papers. There were many researchers, policymakers that in fact did study what do MDIs actually do today? Do they indeed do what they say they're doing? So should we actually help them to stay operating in the markets? Do they actually help our communities? And one of these papers actually do find that MDIs indeed tend to not only locate in the low and moderate income communities or in markets with higher share of low and moderate income communities, but they tend to actually do serve these markets, meaning they do provide financial services within those low and moderate income communities more so than do the non-MDIs. Moreover, when you look at the loan or credit portfolio of the MDIs, these same researchers also find that a considerable share of the loans that the MDIs provide, small business loans and mortgages, they actually tend to go to low-income individuals or minority individuals within those low and moderate income census tracts. Moreover, there were other studies that were done that looked at the MDIs and their effect within the low-income communities from slightly different perspective. So, for instance, if you look at the communities or the census tracts, and if you kind of look at the these low and moderate income communities or census tracts and look at which banks are actually operating in those, if you find a census tract that only has an MDI branch and no other banks, those type of census tracts, they have a much higher probability to be low and moderate income census tract, meaning that those communities probably were not as attractive for other banks, whereas MDI comes in and kind of closes that gap, that financial services gap for the individuals residing in those communities. All right, so that's the research. Do actually data kind of support those findings? So I look at the data, I collect some data and look at the statistics. So on this graph, what I show here is the failure rates, the annual failure rates of banks. So on the y-axis is the annual failure rate as a percentage, and on the y-axis, I look at it over time, beginning with 2001 all the way through 2019. The gray shaded areas represent the economic downturn. So in 2001, there was a dot-com bubble that bursted. Also around that time, 9/11 happened, which affected the economic situation within the US. 2008, I probably don't need to explain, but in 2008, that's the financial crisis. When the market crashed, it was a very big economic downturn, which affected many, many countries globally. And you see that the failure rates, good thing that besides the gray areas, it tends to be pretty stable and actually quite low. However, during the economic downturns, the failure rates tends to uptick a little bit, which makes sense. A lot of people perhaps, or businesses even, default on their credits and perhaps they can't pay back the bank. And so what happens to the bank is that it tends to fail during those times. So that's for all of the banks across US, the failure rates across all commercial banks within US. Let's now decompose the effects across non-MDIs versus MDI. So in here, in green, I present the failure rates for non-MDI banks, and nothing really interesting here, right? We see that it closely follows the trends for the failure rates of the commercial, all of the rest commercial banks within the US. So the trends are not quite different. However, if we take a look at the failure rates for MDIs, what we see is, one, it does kind of follow the trend still. We see that the failure rates are somewhat low when the economy is doing well, but it's high when the economy is not doing so well. But the failure rates are much higher. It's more pronounced for the MDI banks, which intuitively makes sense because these banks are already working with the low income communities, with people that may be credit constrained and may have some kind of economic hardship. So when the recession hits, the communities or the people that they're working with, the market that they serve, will likely be hit much harder. That the effect might be more pronounced for them. But again, I would like to remind you that these are just summary statistics. I'm not controlling for anything. So these are just kind of looking at things without, we can't really make any connections. There's no causal relationship here yet. All right, so what? So we see that these summary statistics are more or less consistent with the literature, with what we've been what I've already found. So what can I do with this? What am I going to do within my research? Whoops, actually, I'm not going to skip that forward. I forgot about the acquisition rate, right? Banks can also exit through being acquired. So if the bank fails, it exits the market, but bank also can be acquired by another bank and it will cease to exist that way. So there's two ways a bank can exit. So here I'm showing the acquisition rate, the annual acquisition rates, also in percentage. This is again, just like before, the acquisition rates for all of the banks, right, across the US. And the first thing that we see, there's not quite, the trends are not as clear as with failure rates. And we see that banks tend to be acquired much more frequently than they fail, which I think is a good thing. We don't want the banks to be failing, right, at the same rate as they get acquired. So let's take a look again, just like before, at non-MDIs. And again, just like before, we see that non-MDIs follow really, really closely the trends for all of the commercial banks. And if we look at the MDIs, we see they don't really follow the trend as much as the non-MDIs, which one explanation is there's not that many MDIs in the sample, or overall in US, there's not that many MDI banks. So therefore, non-MDIs will kind of be driving that overall trend. But by looking at this picture, the only thing that we can take away, at least for now, is that, well, they're not following the same trend, but we can't make any conclusion. There's not really anything that we can say clearly, except that, well, it looks like MDIs are not acquired at higher, they acquire at much lower rates during economic downturns, so they're not super attractive to acquiring banks during the economic downturns. But other than that, there's not no explicit trends or any patterns that we can recognize. All right, so with that, what can we do with this, and what are we trying to do with these information? So the overarching objective of this entire research is to look at, do we or should we even think about the market segment specialization? Because that's one of the major things that differentiates between the MDIs and non-MDIs. And so far, there hasn't been any, well, at the time when I was doing this, there weren't a really clear research that has been done that looked at the market segment specialization. How does it affect the exit rates of banks? And how does that affect MDIs versus non-MDIs? Is that even an important factor that should be considered? So that would be the overarching objective. The more specific questions that I'd like to answer is, does specializing in serving market segments, so low and moderate income communities, that is susceptible to economic downturns, affect the MDI's probability of failure? And does it affect the MDI's probability of being acquired? So the reason why it's not so straightforward to look into it is because, well, we need to think, what does market segment specialization mean, right? And for that, I construct three market segment focus variables. When I construct those variables, there are two specific dimensions I focus on, which identify or which separates or differentiates the MDIs from non-MDIs. One is the geography. So remember, especially if you look at the census tracts, some MDIs, when there's only an MDI, those census tracts tend to be like low and moderate income census tracts. There's higher unemployment rate, poverty rate, and whatnot. So I'm trying to capture that by incorporating the geographic dimension into the metric. And the second one is the socioeconomic factors. Again, poverty rate was important, low and moderate income, and whatnot. I've been kind of throwing that out there. So when I created the three variables, the socioeconomic factors that I considered were the low and the income, the household income within the census tract. The second one is the unemployment rate, which may also affect the well-being, I guess, of the community, right? And the other one is the housing, whether the the house vacancy rate. So why does that matter? It's not super intuitive immediately, but imagine a neighborhood where the neighborhood is thriving, people have good income, steady income. There's less likely to be housing that's vacant. Whereas within the communities where income streams are not steady, people are living from one salary to the next, if they are unable to, let's say, pay their mortgage or their rent, well, those houses, they may have to evacuate them. And if you have seen areas with boarded windows, you probably can decipher that that area probably is not a economically viable kind of area. Okay, so that's the idea behind capturing that that metric. All right, so the other question that I'm interested in is to also think about the non-MDI. So for now, I'm kind of focusing within the MDIs, but what about the non-MDIs? Does market segment specialization affect the MDIs differently than the non-MDIs? So with the second set of questions here, I'm focusing essentially on the differential effect of the market segment specialization for MDIs versus non-MDIs. And what I'd like to highlight here, I'm not trying to compare MDIs to non-MDIs. I'm actually trying to compare MDIs, but within the MDIs. Also, non-MDIs within the non-MDIs. So I want to understand whether market segment specialization itself is an important factor, not just for MDIs, but also non-MDIs. Should we think of the specialization, market segment specialization, as being an important factor for both? And how and whether there could be, those effects could be different for both of these type of banks. All right. To kind of not keep you on the edges of your seats, I'll give you a quick preview of the results of what I'm finding. So I do find that indeed market segment specialization is an important determinant of the bank failures and acquisitions. So it's an important determinant for bank exit. So that's something that perhaps policymakers, regulators, and bankers themselves should be thinking about. So that's essentially the overarching finding. But specifically for MDIs, what I find is something that could be counterintuitive for some. I find that MDIs are less likely to fail when they actually focus their activities on the market segments with on markets with higher low and moderate income communities. So whenever the share of their activities is higher or focus on the low income communities, they actually tend to do better within the MDIs, okay? And so is the higher housing vacancy rate. That was another variable that I was looking at. So essentially what I'm saying is that if you decide to open an MDI and you're trying to serve the low income community, then you better off to actually focusing on those communities rather than trying to do low-income communities, as well as spread your activities to non-LMI communities. How about the non-MDIs? Whoops, okay, again, I'm skipping. Non-MDIs, the result is reversed. For MDIs, acquisition. So again, I actually do find that the market segment focus measures are important for acquisition as well. So they are also significant determinants when it comes to acquiring a bank. So it's one of the determinants that should be considered as well. But what I find is that MDIs are less likely to be acquired when their activities are more focused on low-income communities. And in this particular kind of example, I'm giving higher housing vacancy rate because that was the variable that kind of showed up as being statistically significant. So what that means is that if a commercial bank is trying to acquire another commercial bank, and in this case, we're specifically thinking about an MDI being acquired, the probability of an MDI being acquired. If an MDI focuses its activities on the markets with higher housing vacancy rates, well, that makes them less attractive. I don't want to buy that MDI. Essentially, that's what the finding states. Which that result is probably intuitive because when you're acquiring a bank, you want the bank to be more or less, bringing stable profit. You don't want any type of risk. So therefore, the result is showing up here. And for non-MDIs, the results are actually similar when it comes to acquisitions. Okay. All right. So why should anybody care about this? Why do we even, should be thinking about the exit of the bank, especially for the MDIs, right? So the problem of the MDI exit relates to an important community development problem of access to financial services, specifically for poor individuals and poor communities. It has been shown, and it's known that the access to financial services, whether it's simply being able to have checking account, savings account, or having access to loans and credits, it has a significant impact on the communities, the well-being of the communities. It creates opportunities for the residents of the communities to open a business, to buy a house, to go study at a university, get student loans, for instance, or simply, make the ends meet, and so on and so forth. And with that, therefore, when we think about the exit, it means that if an MDI exits the market, it fails or it gets acquired, it actually may disrupt that local economy. And it's not just a statement, it actually has been shown. The research by Tiwari actually finds that financial services, the access to financial services, it benefits everybody. But the benefits are more pronounced for poor, young, and minority. Let's think why. So poor individuals, they may actually benefit from access to credit to open up a business and pursue an opportunity and profit that way. Young individuals tend to have less savings. I see a lot of young kids, right? Not kids, I shouldn't call it kids. Young individuals, ladies and gentlemen, right? They could also benefit from access to credit, whether it's for education or a car, right? To be able to travel to work and actually make that steady income. And minorities actually a little bit more complex. There could be minorities who travel to US, become immigrants, and for them, it's much harder to kind of establish their roots and credit history and whatnot. And so therefore, the benefits of getting access to financial services could be pronounced for them as well for those reasons. More so, however, if we think specifically about the failures and acquisitions or the exit, so Nguyen finds that whenever a branch closes within a community, let's say, it negatively will affect the credit supply. But the effect is more pronounced for low and moderate income communities. not only more pronounced, it actually gets to, it's more lasting also. Moreover, whenever a new bank comes into that community, it does not actually kind of close that gap, at least not immediately. So when the new entry comes in, it does not alleviate the needs and the needs of the businesses in those low-income communities. So just to kind of give you the intuition, let's say an MDI closes its branch in the low and moderate income communities. Well, they, over time, as they worked there, they actually kind of learned through their experience. They created those relationships, which are very important when giving out credits, especially when working with poor communities and poor individuals who may not have a credit history. So those learnings, actually, the soft information is helpful to make those decisions on who to give out credit to, who is credit worthy, and so on and so forth. And so when the new bank comes in, then it makes sense, even if that bank is an MDI, it will still take some time for it to be able to give the credit. So therefore, it cannot alleviate those needs immediately. All right. So that's the kind of basic overview. So let me quickly tell you, how do I study the question? What is my empirical strategy? So it's a long sentence with lots of words that may not make sense. So I take I use a Cox proportional hazard model with competing risks and time varying covariates. So let me decipher what I'm saying there. So the first thing that I'd like to note is that, again, I'm looking at an exit of a bank, right? An exit may happen either through failure or acquisition. So therefore, the competing risks model, that's one of the aspects of the model I'm taking. It's I use the competing risks approach or model because of the competing risk model, they are well suited for circumstances where a subject, an individual or an institution, can experience an event, or actually several events, such that an occurrence of one of those events can preclude the other. So in the context of the bank exit, there's two events that may happen, right? In such a way that if one of them happens, it means that automatically the other event cannot happen. So if the bank fails, that's it. It does not exist. It cannot be acquired in the future. So the competing risks aspect it accounts for that peculiarity and is able to identify the factors or characteristics leading to each of those events. Next, the rest of the words here mean that I'm taking essentially I'm using a duration model. It might be a little bit more familiar to many of you guys in medicine, perhaps. And the reason why I kind of use that approach versus the discrete choice modeling, which is also popular, is because the duration models or proportional hazard model with time varying covariates not only accounts for the event occurrence itself, 0 or 1, right? Just like discrete choice models do, but it also actually accounts to the time until the event, which is important for us. We don't want the bank just to exist and then fail, let's say, within a short period of time. We want to be able to account for the bank's longevity. We want to differentiate the banks that were existing for a longer time versus a shorter time. Okay, so that also is an important factor here. All right. In the model, there are 3 sets of variables that I consider. The focus are the market segment focus measures, or market segment specialization measures that I construct. And I call them LMI, vacancy, and unemployment to kind of highlight the socioeconomic factors that are being considered in the construction. So the first one focuses on whether the bank is focusing on the low and moderate income communities. The second one is talking about the housing vacancy rate, whether a bank is operating in a market with higher housing vacancy rates, and the unemployment, that one should be self-explanatory, whether whether a bank is operating in a market with higher unemployment rates overall. The second set of variables are essentially to control for bank soundness, right? Whether the bank's operations are sound themselves. We don't want kind of to jumble these two up. Maybe the bank simply doesn't have good operations set up, and that's why it's failing, and it tends to be an MDI. So we want to control for those factors. And these are the standard measures that are used by regulators when they come and look into the banks. FDIC and Federal Reserve banks, they actually check the banks and whether they meet certain criteria to make sure that the individuals using those services are protected. If you have savings account, they want to make sure that the banks are actually honoring or making sure that your savings are safe. And so the way they do it, they use the capital adequacy of the bank. They look whether the bank is sufficiently capitalized. They look at the asset quality of the bank. They look at the management of the bank. They look at the earnings and the liquidity. So CAMEL stands for CAMEL. So I don't have exact same variables that are used by the Federal Reserve Bank, for instance, but I create proxies using the whole reports that is collected by these regulators. And there are other controls that may also interfere with the bank's failure in acquisition. That could be the size, age, loan loss provisions, the MDI status of the bank, and the community bank status of the bank as well. So a bank can actually be a community bank, but it could be non-MDI. So I would like to differentiate those two. All right, so with that, let me present some of the results. So before I jump in, let me explain what those coefficients mean. So these are the three focus measures of interest. And when I run my regressions, I focus on the two primary samples, the MDIs and non-MDIs, given my research questions. But I also kind of I also look at the pooled sample as well, where I add the MDIs and non-MDIs. So for the MDIs, we see coefficients. A negative coefficient means that an increase in a given covariate in the magnitude, if the increase of that variable is associated with a decrease in the probability of failure. So in here, negative coefficient for LMI means that if the bank is more focused, an increase in the LMI. If the bank is more focused on markets with higher low and moderate income communities, its hazard of failure or its probability of failing or exiting the market through failure is decreasing. Okay, so that's what the negative means. And similarly, that's what we find for the housing vacancy rates. So those two are statistically significant. Now, let's take a look at the non-MDIs. So here we actually see that the effects are reversed, and that's what I was saying before, right? So the other two are not statistically significant, although the signs have kind of flipped also. For housing vacancy rate, also statistically significant for non-MDIs, we see it's positive, meaning that for non-MDIs, actually, if they increase their operations, if their market segments focus on the markets with higher housing vacancy rate increases, they're not going to do well. They're actually going to they're more likely to fail, which is opposite of what I find for MDIs. And actually, the adding those two up and not differentiating between MDIs and non-MDIs will give you an impression that, oh, all banks are actually like non-MDIs, which again shows the importance of being able to study these two sets of banks separately. All right, so that's the failure. Let's take a look at the acquisition hazard results. So for the acquisition hazard results, we see that, again, for the housing vacancy rate, so the market segment focus for MDIs, the more MDIs focus their operations on market with higher housing vacancy rate, means their probability of being acquired is decreasing, meaning that they're less attractive targets for acquiring for other banks. They're less attractive acquisition targets. And we see similar results for non-MDIs, actually, meaning, again, for non-MDIs, and I will come back to LMI for non-MDIs, vacancy and unemployment variables, we see that the more non-MDIs focus their operations on markets with higher vacancy and higher unemployment rates, the less likely they are becoming attractive for other banks to get acquired, okay? So LMI is a very peculiar one in here. If you guys see, the market segment focus measure for LMI, for acquisition, has a flip sign. Maybe counterintuitive, but only if you don't understand how the regulations work for banks. Banks are subject to many, many regulations. So all of the banks are required by the Community Reinvestment Act to serve like a certain threshold, a certain percentage of low and moderate income communities. And so when one bank tries to buy another bank, when they're trying to acquire and try to merge, those mergers and acquisitions, they go through many different stages of approval. They have to be approved by the regulators. And guess what? Because of the Community Reinvestment Act, they will consider, okay, after the acquisition, will this bigger bank, joint bank, be ignoring the low and moderate income communities? What will that share look like? And the more they can show that we're not ignoring the low and moderate income communities, the more the acquisition request actually likely to go through, which is why, or which could explain why the market segment focus on the low and moderate income communities, the coefficient for that is positive, right? Any questions so far? Okay, well, let me kind of quickly summarize what I just said in a very quick table here. So for MDIs, we find that the market segment focus measures saying that, okay, if your market segment focus increases for low and moderate income communities, for these for the communities susceptible to economic downturns, that is going to positively correlate with the failure, meaning that is actually going to negatively correlate, meaning it will positively affect your probability of failure, meaning you're less likely to fail if you increase your focus on the communities that are susceptible to economic downturns, okay? However, for non-MDIs, we find the opposite effect. If you're increasing your market segment focus on operating in the communities with higher share of low and moderate income communities, on communities with poor individuals, with minority individuals, you're actually increasing your probability of failure, which is opposite of MDIs. And for the acquisition, we found that the effects are not differentiated. They're similar for MDIs and non-MDIs, and both are less attractive if they focus their operations on poorer communities. All right. So what are the kind of overarching implications? What are the main takeaways? Well, great, we found that market segment focus measures are important. Yay for me. My dissertation is probably on the way to, make sure that I can graduate on time. But besides that, it's an important topic because with the, what it means is that for MDIs in particular, the general kind of consensus was, even among economists, that, well, MDIs should actually, maybe not focus on these low-income communities, which is not congruent, or it does not meet to why MDIs exist in the first place. And so what I find is that, well, actually, no, if an MDI, exists for whatever purpose they decided to exist for, right, serving the low-income communities, once they make that decision, it is actually better for them to focus on that mission, and it's better for them to focus on those markets and not focus on anything else, which actually helps them manage their risk. Just like I explained before, working in those or with those low-income communities requires a lot of learning and a lot of information, soft information. So therefore, when they tend to focus, they are able to acquire that knowledge and establish those relationships and apply it to risk management. So that is what kind of main takeaway is, which is somewhat different than what was thought of previously. Moreover, it's important. These insights are important to devising policies for MDI. So the status of MDI gives it's protected. It kind of protects these banks. There are certain policies that by the FDIC and other regulators where they kind of help ensure that the MDIs are somewhat protected. But with these additional insights, these policies can be honed, and they can be sort of targeted, and they can now understand a little bit better and make those policies less invasive in order to preserve these type of banks. And finally, the information is also useful not just for the policymakers, but also for the leaders themselves. There are many community organizations, institutions that kind of work with the MDIs for various purposes. There's banking sector experts, NGOs and whatnot, and the MDI leaders themselves. I think for them, it's also important to understand strategically what should they be doing when they operate. Should they try to diversify their operations, or should they focus more, and why? So that's another kind of takeaway and important learning from this research. So that's all I have. Thank you so much. Really open and look forward to your questions. Oh, it's right there.
Any questions? Okay, I see a lot of questions.
Good.
Very excited. Thank you for the talk. Do you use any machine learning or artificial neural networks methods in your research?
Not for this one, no.
Or do you know any example that is being used?
No, I don't know. I don't know of any other research that would work, would implement the machine learning. It certainly can be done. One advantage of the machine learning is the scalability, right? Being able to use lots of data. With banks, actually, your data set is quite limited in the sense that there's only so many banks. And actually, the number of banks is becoming smaller because of the acquisition rates. Banks are kind of consolidating. So in that sense, I think with the machine learning, that would be one advantage, which is not present in this case scenario. And moreover, with machine learning and other aspects, the challenge would be then kind of deciphering or kind of separating out the effects and be able to explain which one contributes to which. And so if you think of the counterfactuals, right, when you're trying to understand what would happen, right, the kind of what would it be, the alternative world. So that could be the challenging part with machine learning. It certainly can be done. I'm not aware of research that is making use of that. But I'm kind of trying to explain why it could be, why people are not kind of applying the machine learning strategies.
Yeah, thank you.
Out of curiosity, how many MDIs?
How many MDIs? I don't know right now how many, but there's, I think, around 100. If my memory is correct, I can get back to you with the exact number, but there's maybe around 100 something. There's not that many. That's all over US.
I think it's enough number, right, for AI study. Okay, I saw some other questions here.
Dr. Babajanova, thank you so much for a very interesting presentation, but the majority of us not really clue about the banking, but you did bring very cool things. First of all, thank you for the hard work. It's a kind of advisory for each of y'all who made the speech, including yourself. Our folks being here today to give the word for next generation of our researchers, for our new PhD and the doctors. What I would like to ask, everyone who presenting there, in the end, just encourage new baccalaureate degrees, or even in college stage and the junior college students, what we can achieve it's not easy. As personally, I know you closer. With family sport, you did a super excellent job. It's not easy. My folks, again, what I'm trying to bring, when I come over here in 1996, maybe I was only one individual or two. Now, today, we have over 50, 60, maybe 100 MDs and PhDs, but we just know 5, 6 of y'all, or 10 maximum. Our folks to bring the words for next generation. Now, question directly to you. How does individual, or I know some of the young guys as a businessman working, can we take something from here about the MDI, where we need to focus if we were get the loan, like I know when you did this research, you didn't just a few things, you go very wide, Give us as a specialist and to understand, where we live in our area, how we can focus where can find of the MDI bank and what we can get from there. And plus, we are so proud of you and other doctors to the achievements. Thank you so much.
Thank you.
You
Appreciate it.
You have your microphone.
Thank you. I guess it depends on where you are located. I can maybe there are many ways that you can find an MDI bank through regulators. They have a list of protected of the MDIs, and they have many branches, which makes it slightly more challenging for me to be able to give you which MDI is near you. So that requires like a quick maybe search. So in that sense, I unfortunately won't be able to provide that type of advice. In terms of loans, I know coming into US, it's actually much more challenging to find a loan, especially if you're on a student visa. There's not many avenues in US to take out a loan unless you have a green card or if you're a citizen, especially when it comes to student loans. I don't think you are able to get out a loan unless you have somebody that can sign for you, that in case of a default, that person will take that financial responsibility for you, which is very, very challenging to do. So unfortunately, as a foreigner, there's not that many avenues. But once you become a citizen of US or once you become a green card, there are many more opportunities. Yeah. So that's one. But there's another thing that you can take away from the research specifically for you guys. If you think much wider in terms of specialization versus diversification, think of it that way. So if you're, I know there's a lot of doctors, and I apologize for kind of referring to many doctors, medical doctors, let me say it that way. So think about whether as a person, me as a, for my career, will I benefit from specializing or will I benefit from actually diversifying? So I think that's the message that that could be taken away from here. So for medical doctors, it probably makes sense to specialize more. So let's say a neurosurgeon. Would you want to go to a neurosurgeon who is trying to diversify their skills in neurosurgery and cardiosurgery? Probably not, because it's a very, very technical, very hard thing to do neurosurgery. So therefore, it requires many, many years of practice. And therefore, specializing there is probably a good idea. So if you're going in a medical field, perhaps for you, the advice is make sure that you specialize and you understand and you practice your skills. But if you're someone like me, an economist, right? So they're actually diversifying your skill set a little bit can become valuable, not just knowing. So of course, you need to kind of make sure that your basic skills are, top notch, that you know how to do the quantitative analysis. But as an economist, where your value comes in is to understand various contexts and understand various fields where you can add value. So that would be, sorry, unrelated advice, but coming from the paper.
I have a question.
Yeah.
What's the different regulations for MDIs and non-MDIs? Are they as heavily regulated as non-MDIs?
Thank you.
That's
Yes.
one question. And the second question is how common it is for NDIs to actually purchase, non-MDIs to purchase MDIs to then further acquire other banks? Because I've been through a couple of acquisitions and I feel like they do that as a gameplay. So that was.
Yeah, I don't have a good answer for the second one because I did not look through that. For the first one, I think it depends. So the regulations are very, very complex for the financial institutions, and they may vary not just by the bank status, MDI, non-MDI, community bank, but also the size of the bank will make a difference. So the capital requirements will vary based on the size of the bank. So there could be much stricter in terms of how much capital you're supposed to hold on to if you're a larger bank versus if you're a smaller bank, the requirement could be slightly different. For the MDIs, I think the primary difference in terms of the regulation would be their preservation status. So there are certain policies, there are certain policies that are sort of targeted at the MDIs to help them to make their lives easier, I guess, to put it in like common words. And those come from various, again, I won't be able to list all of them because there's many different regulators and many of them will have their own kind of ways they do it. It could be through capital requirements. It could be through certain funding. It could be through certain incentive programs when they work, let's say, with certain businesses. They may have, tax credits for them, things like that. So there's many of those little ways how they do it. So that's one. The Community Reinvestment Act might be more challenging for, let's say, non-MDIs because, they have to kind of vigilantly make sure that they are serving those low-income communities. And actually, there are a lot of how should I say, the think tanks or even like companies that kind of help these banks to make sure that they meet their targets. Whereas for MDIs, I guess it comes with the status. So those aspects might be slightly less challenging for them.
How often do MDIs merge within a market, within LMI?
Within themselves?
Yes.
I don't have that statistics.
Does that happen though?
I think it does. I think it's been a while since I actually don't do any type of MDI work. But when I did look at them, they did. They are though, the MDIs are actually more likely to fail than they get acquired. So I think that's the challenge because a lot of them, if you think of the MDIs, they tend to open by minority individuals that sometimes, historically, it would be the individuals. Why do I open an MDI if I'm a minority? Because I noticed that the financial services for, let's say, my people are not available. I may not know myself how to make it work, but I'm going to open because I see the need. But with that comes challenges because I myself need to understand what's happening. So that kind of opens up those risks. And that could also actually somewhat explain why focus helps as well. Mm-hmm. Yeah.
Thank you. I have a question. You have a dichotomous variable that the MDI versus non-MDI.
Yeah.
On the summary statistics, it shows that non-MDIs are way higher than the all, and MDIs are much higher than non-MDI and all and non-MDIs are similar pattern they are showing.
For the failure rate?
Yes.
Uh-huh.
So why is that so? Do you have a very few amount of observations for MDIs?
So for MDIs, there are indeed less of them. Sorry, let me go. So let me first kind of, that's a very good question. So first, let me clarify that this is a percentage. So it's not in like, this is percentage, the failure rate. So let's say we observe 100 banks here. I would look at how many of them failed. If 2 of them fail, that means the failure rate is 2% here. So it's a percentage, which is comparable, right? I'm comparing percentages to percentages. But you're right that to explain the trends, one of the explanations, which is why I kind of highlighted that this is just a summary statistic, I'm not controlling for anything else. There are many more non-MDIs. And there are less there's less MDIs. So the share of the MDI banks is very small. And therefore, that could explain, actually putting them together, if you look at all the banks, so let me go back again. Oops. So if we look at this, the trends actually is being driven mostly by non-MDIs because there's so many of them. Does that make sense? But differentiating them, the separating them out is important to be able to understand that, you know, the failure rate is much more pronounced. And I kind of, when I do my analysis, I control for those other variables to make sure that it's not, you know.
Right. And also your significance levels, you pulled the commonly accepted one is 0.5. You pulled it up to the 10%. And did you do that to make sure that the all non-MDI and MDIs are significant for LMI?
Sorry, I'm not sure I follow the question.
On the, if you go to the significance result. Next. The next one, please.
Next
yes,
one?
Here.
Oh.
MDI, non-MDI, and all.
Mhm.
So is that the reason why you use the 0.1 instead of 0.5 as your significance level? Probably you might not remember already.
These are just standard ways of, at least, I don't know, at least in economics, these are the standard ways.
That's the that's standard
That's,
in
that's
economics?
just the significance levels,
No,
right?
no, I
The 10%.
I understand, but isn't the standard is 0.05, 0.01, and 0.001? Yes, instead of 0.1?
10%, 5%, 1%.
I understand, but isn't the standard is 5%, 1%, and 0.1%?
Maybe. Yeah, I'm not sure. This is the literature in economics. That's what I'm following. But yeah, I'm not sure. Maybe that's true for other fields.
Yeah, more questions.
No, yours.
Oh, yeah, I have a lot of questions, but I think it's surprising to see that this type of niche presentation, and it's very commendable, gets a lot of engagement, even though we are out of glucose in our brains and close to the lunchtime. And yeah, I have a lot of questions we can catch up, you know, during the lunch. I'll list them here. So looks like the MDIs serving the poor areas, higher vacancy rates are actually resilient, correct?
Right.
So.
But this is again within MDIs. We're not comparing them to non-MDIs.
That's
yeah.
understandable.
Mhm.
So given your role in Amazon, right? I would like to translate this. Do you see small Amazon sellers that are serving these communities? Is there any parallels or the same signals that, you know, failure rate or rate of acquisition, right? It's just food for thought. And secondly, I'd like to comment on her point where MDIs merge, right? So since the MDIs emerge with, let's say, a certain goal, right? Serve my community, I don't know if they would like to merge and serve whose community or purpose, right? So MDI 1 versus MDI 2. So maybe that's the reason we don't see a lot of mergers. I don't know.
That's a very good point. That's actually has some truth to it. And again, because you know, you have to kind of go and do some kind of conduct maybe interviews to understand that. But indeed, MDIs also kind of when they say I'm an MDI, they sometimes like to differentiate themselves. I primarily serve Hispanic communities, or I primarily serve Black communities. So in that sense, there could be some frictions when there's two MDIs, but one focuses on Black communities, one on Hispanic. Perhaps they may not want to merge for those reasons, because of this unique differentiation. But again, that's just like an anecdotal type of theoretical potential explanation. But to tell you for sure, they would require some research.
Thank you very much.
Thank you.
That's it. Yes.